When people talk about big market crashes of the past, the stories can make it seem like these crashes were random lightning strikes. They were anything but. Every major market collapse of the last 50 years shares the exact same 4 traits, and all 4 are visible in the market you're invested in right now. Of course, anyone claiming to know the exact date of the next market crash is simply full of it. But what you can do is recognize the setup before you become someone else's exit liquidity. So today, we break down the 4 traits that appear in every crash, watch them show up in half a century of history, and then look at where they sit in the market today so you can prepare yourself. My name is Nick, and this is the Finance Bureau. Now, most people think that there are lots of different kinds of crashes: an oil crash, a property crash, a tech crash, a banking crash. But when it really comes down to it, that's an illusion. Because when you really dig into the details, every real crash is made up of the exact same 4 ingredients. So let's lay them out, and you should keep these in mind as we proceed with the rest of the video. And the first trait is prolonged overvaluation, completely disconnected from the underlying fundamentals. And prices float free of what the assets are actually worth. And trait 2, which is the real beauty here, leverage. Borrowed money layered on top of borrowed money, making every loss worse when the tide finally turns. Trait 3, a macro shock that exposes fragility. And note that I said the shock exposes fragility. It doesn't create it. The trigger people end up blaming is never the actual cause. And then there's trait 4, the sudden shift in sentiment that turns euphoria into panic. And here's the thing to remember when it comes to these 4 traits. Instead of 4 separate types of crash, every major crash contains all 4 of these elements at the same time. And that's what makes it a pattern. So let's test that pattern against the record. Let's take things back to the 1973 oil crisis. The Nifty 50, including Xerox, Polaroid, and IBM, were all seen as one-decision stocks. Buy them and never sell, regardless of price. By late 1972, Nifty 50 stocks commonly traded at a price-to-earnings ratio of 50 or higher, well above the market's long-term average of around 15 to 20. And there, my friends, is your overvaluation. Vietnam-era spending made high inflation a consistent issue, and short-term rates were climbing toward double digits, building leverage and tightening before things really got shook up. And then the shock arrived. In October 1973, OPEC's embargo quadrupled the price of oil from around $3 a barrel to $11.65. Stagflation set in and sentiment cratered, and the Dow lost roughly 45% of its value. Now let's hop back into our time machine to Japan at the end of the 1980s. One of the core market beliefs of the time was that land never goes down. Cheap credit and enormous leverage sent the Nikkei and Tokyo real estate into the stratosphere. At the peak, the land beneath the Imperial Palace was theoretically worth more than the entire state of California. The telecom giant NTT reached a market cap of around $350 billion, more than the 8 largest American companies combined. There was the overvaluation, disconnected from the fundamental, and there was also leverage running through every facet of the system. And then, in 1989, the Bank of Japan started hiking rates, and that was the shock. Sentiment reversed sharply, and the Nikkei fell more than 63% by 1992. Skip forward a few years, and let's look at the infamous dot-com bubble. By March 2000, the Nasdaq traded at a price-to-earnings ratio of 200. And get this, 74% of surveyed internet companies had negative cash flows. Profitless businesses valued on hype alone. The telecom sector had drowned itself in debt to lay fiber nobody was actually using. So again, there's your leverage and your overvaluation. And then the Fed raised rates, sentiment snapped, and euphoria became panic. The Nasdaq fell around 78% and didn't reclaim that peak for 15 years. And finally, of course, let's look at the global financial crisis of 2008. As we know, subprime mortgages were bundled into securities, stamped AAA, a rating that was supposed to signal the highest quality, and then these were leveraged to the hilt. Lehman Brothers was sitting on $680 billion in assets, supported by just $22.5 billion of actual capital. A leverage ratio where a 3% fall in the asset values would wipe out the entire firm. Housing was overvalued on the belief that prices could only ever go up, and sentiment was euphoric. And then Lehman collapsed in September 2008, and that was the shock to the system. And sure enough, the S&P 500 fell around 57%, although there were some that saw it coming. Michael Burry loaded up on credit default swaps against those bonds and walked away with roughly $725 million for his investors and $100 million for himself. He didn't predict the exact date that everything fell apart. In fact, it was actually quite early, and many ridiculed him about it. But Burry recognized the setup, and he was proven right in the end. In our brief run-through of recent financial euphoria, we had oil, real estate, tech, housing. 4 completely different stories, 4 different decades, and 4 very different triggers. But the same 4 traits are there: overvaluation, leverage, a big shock, and a nasty sentiment shift. It's absolutely crucial to your portfolio that you recognize this pattern when it shows up. But to be fair, you probably don't have 16 hours a day to track everything going on in the market. And that's why you should sign up for the Finance Bureau newsletter. It's absolutely free, and we break down everything regarding global finance, macro trends, and anything else that can move your portfolio so that you never miss what truly matters. And all you have to do is click the link in the description or scan this QR code on the left of your screen to get started. At this stage, now that we've identified all 4 traits in this pattern, then the only question worth asking is, how many of them are present in the market right now? Well, let's begin with overvaluation. So, as I record this, the Magnificent 7, or the Mag 7 for short, which we know is the mega cap tech names, account for somewhere around 32 to 35% of the entire S&P 500. Now, stretch that to the top 10 companies, and you're looking at over 40% of the whole index on certain days. Now, let's compare that with the past, shall we? At the dot-com peak in 2000, top 10 concentration was much lower than it is today. We have now blown well past it. The concentration is more extreme today than it was at the height of the last great tech bubble. There are also easy comparisons to the Nifty 50 mania, a handful of quality names treated once again like a one-decision forever hold stock regardless of price. And we've seen this exact same psychology before. The Shiller-Cape ratio, a long-term measure of how expensive stocks are relative to a decade of earnings, is sitting at around 40. That's the second highest reading in more than a century. The only time it was ever higher was at the dot-com peak of 1999, when it hit 44. The Buffett indicator, which is the total market value against the size of the economy, is running between 217 and 228%. Needless to say, these are not normal numbers, and this is the type of thing that you only see near a big market top. And the fundamentals underneath? Well, the 4 biggest hyperscalers are guided to spend around $725 billion on AI capital expenditure this year alone, up 77% from the year before. But the revenue to justify those spending numbers simply isn't there yet. These valuations are pricing in a decade of flawless execution. In other words, the market is paying today for profits that may never arrive. With that in mind, let's look at today's market through the lens of another of our 4 common traits: leverage. Margin debt, which is the money investors borrow against their portfolios to buy even more stock, has surged over 50% year on year, sitting north of $1.4 trillion. And the net credit balance, which is basically the cushion investors hold against forced selling, has hit a record negative $991 billion. That's the thinnest safety margin on record. When prices fall, that thin cushion is what turns an ordinary sell-off into a forced selling cascade. And there's another part of the story when it comes to leverage: private credit. This is the lending that happens outside of banks, in the shadows, where disclosure is thin and prices are murky. it has ballooned to somewhere between $1.5 and $2 trillion, with some estimates reaching $3 trillion once you include the wider shadow banking machinery. In May of this year, the Financial Stability Board issued a warning, flagging data opacity, maturity mismatches, and rising payment-in-kind interest, which is just another way of saying borrowers are paying their interest with debt instead of cash. The same board reports private credit defaults are rising, albeit from a historically low level. And regulators have flagged bank exposure to these funds in the hundreds of billions of dollars, with 6 major US banks reportedly holding $322 billion in committed lending to private equity and credit fund sponsors per the FSB. So there is simply no way that this would stay contained in the shadows if the tide truly turns in the markets. So far, we have overvaluation and piles of leverage, and that's 2 of the 4 common traits of major market crashes. And the next feature would be an acute shock to the system before the final trait, which is that sharp sentiment shift. Now, we won't pretend to predict the exact event that acts as the next shock, the straw that breaks the camel's back. But interestingly, we can already see signs of sentiment shifting. And that's clear to see in how brittle confidence is in the AI trade. A single earnings miss is enough to erase hundreds of billions of dollars in market value. For example, Meta shares slid simply because it raised its spending guidance without proving the revenue. TSMC fell despite strong profit growth, purely because its capital forecast came in higher than hoped. And that's what priced for perfection looks like. And recently, one particular market event spoke volumes. In July, a Chinese open-weight AI model called Kimi K3 launched, proving high-performance AI could be built far more cheaply than the premium valuations assumed. The Philadelphia Semiconductor Index tumbled into a bear market, shedding roughly $3.3 trillion in value in a matter of weeks. Markets are whipsawing on tariff headlines, on policy noise, or on a single line of guidance. And what we have here is the thin confidence cracking on small shocks. And one of these surprise headlines could end up being the big one that completes the pattern for a major market crash. So, let's sum this up. Overvaluation more extreme than the dot-com peak. Leverage at record levels, both in the open and in the shadows. Speculation running on the belief that this time is different. And sentiment so fragile it buckles at the smallest surprise. The pattern that preceded every major crash of the last half-century is essentially complete in today's market. The overvaluation, the leverage, and the speculation, they're all there. And the sentiment is hanging by a thread. Every ingredient is present. The only thing missing is the one big shock. But of course, the shock is never the part you see coming. I mean, nobody circled the OPEC embargo on their calendar in the 1970s. Staff arrived in Lehman offices worldwide ready for a full day of work and were told that the company was then going under. The trigger always looks obvious in hindsight, but it's virtually impossible to tell beforehand. Now, there's one other thing we should discuss today. The people who lost everything in every one of these crashes all believed the exact same thing, that this time is different. Investors borrowing against their homes in 1989, Japan believed it, just like the traders buying profitless dot-coms in 2000, and the bankers leveraged 40-1 in 2007. Each time, people told themselves that the old rules no longer applied, but they always did in the end. But where does this leave you and your money? Well, if you hold a broad index fund, understand that you no longer own a diversified basket you think you own. With the top 10 names accounting for up to 40% of the entire index, your retirement is now a concentrated bet on a handful of AI stocks. If you use in margin, you're potentially flirting with the idea of becoming a forced seller. And if you hold nothing but the belief that the line always goes up, well, so did everyone who came before you. But there's one great feature of big market crashes, at least for those that prepare themselves. Every one of the crashes we looked at today was also the single greatest buying opportunity of its decade. The Nikkei, the Nasdaq, the S&P, every one of them eventually delivered generational returns, but only to the people who saw the setup coming and didn't get wiped out reaching for the top. They succeeded by recognizing the 4 traits we looked at, keeping their leverage sane, and having capital left to deploy when everyone else was panic selling into the floor. The losers handed their wealth over as exit liquidity to the people who read the setup early. When it comes down to it, that's the oldest story in finance, and it's playing out again right now. So, assuming the top names of today can only ever climb upward is just naive. AI is great tech, just as the internet was majorly impactful, just as Japanese industry was the biggest in the world. But the price has detached from reality, and leverage is getting stacked, all while confidence is becoming thinner. The pattern is recurring, so make sure you don't get caught making the same mistakes countless people have before you. Well, that's all we have time for today, but what do you think? Do you believe this time is different because AI changes everything? Or is this the exact same setup we've watched play out for 50 plus years? Let me know your thoughts in the comments down below. And if you want to understand the debt time bomb sitting underneath all of this, the de-dollarization story and the breakdown of the system itself, then you can check out our video on that right over here. As always, thank you very much for watching, and we'll see you in the next video. This is Nick, signing off.